So what is mortgage insurance? Lender's mortgage insurance is a once-off insurance premium paid by the borrower when they are unable to obtain the 20% deposit required by the bank. When you're borrowing 80% of the value of the property, lender's mortgage insurance isn't required as they believe the 20% down payment is sufficient to cover any potential losses. However, if a borrower is required to borrow more than 80% of the value of the property, banks would view this as a more risky application and would require the borrower to buy insurance in the event that the bank is unable to recoup all their money back. So how is mortgage insurance calculated? Mortgage insurance is calculated based on how much deposit you have and how much is the purchase price of the property. The more deposit you have, the less mortgage insurance you have to pay. If you're borrowing more than 80%, the mortgage insurance cost increases every percent above 80%. So how much savings do you need to avoid lender's mortgage insurance? As a financial consultant, we would prefer to avoid mortgage insurance as much as possible. To avoid this, lenders would like to see 20% deposit through cash savings, in stocks, or the use of a guarantor will also help. Therefore, if you're purchasing a property for $1 million, to avoid mortgage insurance, you would need $200,000 as a deposit plus stamp duty of $40,207. Is paying lender's mortgage insurance a bad thing? A lot of property buyers feel paying lender's mortgage insurance is a bad thing and would prefer to save up the 20% deposit plus stamp duty to avoid this expense, which is fine because everyone has their own personal preferences. But paying lender's mortgage insurance shouldn't be seen as a bad thing, but rather an opportunity for you to get into the market earlier. For example, median house prices in Sydney grew by 28% from September 2020 to September 2021. If you paid the 2.21% premium on mortgage insurance to get into the market earlier, your growth on the property today would just be under 26% based on core logic. Obviously, this is abnormal growth. But let's say if you purchased a property back in June 2017, where Sydney house prices was $1,178,000, and if you paid the 2.214 mortgage insurance premium, in September 2021, the median house price was just under 1.5 million. That is a 27% growth rate over 4 years. Now, if you take that into perspective, how long would it take you to save up an additional 10%? Therefore, paying LMI is not always a bad thing. So how is lender's mortgage insurance paid? Lender's mortgage insurance is capitalized onto the loan. However, the bank will only lend up to a certain percentage of the value of the property. We call this loan to value ratio. As an example and guide, for an owner-occupied loan, banks will lend up to 95% of the value of the property, including mortgage insurance. Therefore, if you have 8.5% deposit plus stamp duty costs, meaning you will borrow 91.5% of the purchase price, and let's say mortgage insurance is 3.5%, that gets capitalized onto the loan, this means your end loan will be 95%, which is the limit on what the banks can lend against that property. For more information about lender's mortgage insurance and lender's mortgage insurance waivers, please contact us at the mortgage agency. And we'll see you next time.